Picture this. It is the last week of February 2026, and something just happened in Shanghai that should have every silver investor on the planet paying attention. But you will not hear about it on the mainstream financial channels. You will not see it trending on social media. The algorithms have buried it, the talking heads have ignored it, and yet this single regulatory change could be the most important development in the silver market this year. The Shanghai Futures Exchange just announced that starting from the last trading day of February, non-futures company members, overseas special non-broker participants, and clients who have not obtained near-delivery month hedging transaction limits will have their general month hedging positions automatically converted to zero. Zero contracts. Let me translate that from regulatory speak into plain English. Shanghai just told Western speculators and certain foreign participants that they cannot play in the delivery months anymore. They are being locked out. The largest silver futures market in the East just erected a wall, and the implications are staggering. If you are watching this, you're about to understand something that 99% of investors will miss entirely. Welcome back to Mr. Ag. I am your host, and today we are going to decode what Shanghai is really doing, why the rate cut rally is not a dead cat bounce, and how these two forces are converging to create what could be the setup of the decade. Grab your coffee. Tell your family you are in an important meeting, and pay very close attention because the next 15 minutes could change how you see this entire market. Before we dissect the Shanghai bombshell, I want to know where you are watching from right now. Are you an early bird in Sydney, catching this before the Asian markets open? Are you on your lunch break in Frankfurt, trying to make sense of the volatility? Maybe you are burning the midnight oil in Toronto, unable to sleep because the charts keep calling your name. Drop your location in the comments below. I want to see how far this community reaches, because what we are witnessing is a global phenomenon. The decisions being made in Shanghai affect the price you pay in Mumbai. The rate cut expectations in Washington ripple through the dealers in Dubai. We are all connected now, and understanding that connection is the key to understanding where this market is headed. Let us start with the Shanghai announcement, because this is the news that should have stopped the financial world in its tracks. The Shanghai Futures Exchange, known as the SHFE, is not some minor regional exchange. It is the dominant platform for precious metals trading in Asia. When Shanghai speaks, the physical market listens, and what Shanghai just said is profound. According to the official notice, they have decided to adjust the hedging limits for silver futures. Specifically, participants who have not obtained approval for near-delivery month hedging will have their positions in those months reduced to zero. This takes effect at the end of February. Now, to understand why this matters, you need to understand how futures markets work. A futures contract is a promise to deliver or receive a commodity at a specific date in the future. As that delivery date approaches, the contract enters what we call the near-delivery months. These are the months where paper promises become physical reality. These are the months where you have to put up or shut up. By restricting who can hold positions in these critical months, Shanghai is essentially saying that only serious players with pre-approved hedging needs can participate in the delivery process. The speculators, the overseas participants who have been using these contracts to bet on price movements without any intention of taking delivery, they are being shown the door. Think about what this means for the dynamic between paper and physical. The paper market works because most participants never intend to take delivery. They trade promises back and forth, profiting from the price swings, and they close their positions before the delivery date. This creates massive leverage. Hundreds of paper ounces traded for every physical ounce in the vault. But if you start limiting who can participate in those final months, you are forcing a closer alignment between paper and physical. You are reducing the ability of speculators to manipulate the price near delivery. You are giving the physical market more power over price discovery. And you are signaling that Shanghai wants its silver market to be about actual metal, not financial engineering. Now let me ask you a question. Why would Shanghai do this now? Why would they tighten the rules at this particular moment in time? The answer, I believe, lies in the broader geopolitical and economic landscape. We are witnessing the greatest financial chess match in modern history, and silver is one of the pieces on the board. China has been accumulating physical precious metals for years. The People's Bank of China has been adding gold to its reserves at a record pace. The Shanghai Gold Exchange consistently trades at a premium over London and New York, acting like a giant vacuum cleaner that sucks physical metal out of Western vaults and deposits it permanently in the East. The silver market is following the same pattern. China is not just a buyer, China is becoming the center of gravity for physical precious metals. And by tightening the rules on its futures exchange, by limiting the ability of overseas speculators to play games near delivery, Shanghai is consolidating its control over the price discovery mechanism. This is not a random regulatory adjustment. This is a strategic move. The West has used paper markets to suppress precious metals prices for decades. The East is now saying, not anymore. Not on our exchange. Not with our metal. While Shanghai is rewriting the rules, the Western markets are dealing with their own earthquake. The economic data coming out of the United States is flashing warning signs that cannot be ignored. Let me walk you through what just happened, because the implications for precious metals are profound. The latest retail sales figures came in flat. 0% growth. The market was expecting an increase of 0.4%. This is not a minor miss. This is a signal that the American consumer, the engine of the U.S. economy, is sputtering. Remember, consumer spending accounts for roughly 70% of U.S. economic activity. When the consumer stops spending, the economy slows. When the economy slows, the Federal Reserve has to respond. And how does the Fed respond? By cutting interest rates. The market is now pricing in at least 2 25 basis point rate cuts in 2026, with the first potentially coming as early as June. Some analysts are whispering about even more aggressive action if the data continues to deteriorate. This is the core catalyst driving the current rally in gold and silver. When interest rates fall, the opportunity cost of holding non-yielding assets like precious metals decreases. Money flows out of bonds and into bullion. The math is simple, and the market is doing the math. But there is another layer to this story, and it involves the dollar itself. The dollar index slipped to 96.59, down nearly 0.25%. This might seem like a small move, but in the currency markets, small moves have massive implications. When the dollar weakens, commodities priced in dollars become cheaper for international buyers. A buyer in India or China or Europe can get more silver for their local currency. This increases demand, which supports prices. And the dollar weakness is not happening in isolation. There are structural forces pushing against the greenback. The fiscal situation in the United States is deteriorating. The national debt is at levels that would have been unthinkable a generation ago. Foreign central banks, including China, are rumored to be reducing their purchases of U.S. Treasury bonds. The weaponization of the dollar through sanctions has made other nations wary of holding too many dollar-denominated assets. All of these factors are converging to create an environment where the dollar is losing its grip on the throne of reserve currencies. And when the dollar weakens, gold and silver rise. Not because the metals are gaining value, but because the measuring stick is shrinking. Let me show you how this played out in the price action. On the multi-commodity exchange in India, gold futures for April delivery climbed nearly 1% to 158,200 rupees per 10 grams. But silver was the star of the show. Silver futures for March delivery surged 3.83% to over 262,000 rupees per kilogram. Silver outperformed gold by a factor of 4. This is significant because it tells us something about the market psychology. When silver outperforms gold, it typically signals that investors are becoming more aggressive. They are reaching for the higher beta play. They are betting that the rally has legs. The gold to silver ratio is a key indicator that professional traders watch obsessively. When this ratio is high, silver is undervalued relative to gold. When the ratio falls, silver is outperforming. Right now, the ratio is trading above 61, which historically suggests that silver still has room to catch up to gold. If the ratio reverts toward its historical averages, silver could significantly outperform in the months ahead. Now, I want to address the bear case head-on because I know some of you are skeptical. And frankly, you should be. Skepticism is what keeps you from being the exit liquidity for smarter money. The bears point to several factors that could derail this rally, and we need to examine each one honestly. First, there is the volatility argument. The precious metals markets have experienced extreme swings in early 2026. We saw record highs followed by brutal corrections. Gold and silver gave back a significant portion of their gains, erasing trillions in market value globally. This kind of volatility scares people. It makes investors question whether the rally is real or just speculative froth. The bears argued that the late January and early February correction was a warning shot. They point to the increased margin requirements implemented by the CME, which forced leveraged traders to liquidate their positions. They highlight the reduction in managed money positions, noting that gold net longs are at their lowest level since October, and silver net longs hit a 23-month low. This positioning data suggests that the speculators have already fled. The bulls are exhausted. The easy money has been made. Second, The bears point to the Kevin Warsh factor. When President Trump nominated Warsh as the next Fed chair, the market algorithms interpreted it as a hawkish signal. Warsh is perceived as a strong dollar advocate, someone willing to keep rates elevated to fight inflation even at the cost of economic pain. The nomination triggered a repricing of rate expectations, which contributed to the precious metals sell-off. The bears argue that as long as Warsh is the presumptive Fed chair, the market will be reluctant to fully price in aggressive rate cuts. This creates a ceiling on gold and silver prices. Third, the bears highlight the speculative excess that preceded the correction. Much of the rally was driven by momentum traders, algorithmic buying, and what some analysts describe as speculative flows from China. When prices move too far too fast, divorced from underlying fundamentals, they become vulnerable to sharp reversals. The bears argue that the market needed to reset, to shake out the weak hands, and that more pain may be necessary before a sustainable bottom is formed. I have listened to the bear case. I have considered it carefully. And here is my response. The bears are looking at the chart. They are not looking at the map. Yes, the volatility was extreme. Yes, the speculative positioning got ahead of itself. Yes, the correction was painful for those who bought at the top, but none of that changes the fundamental reality of the silver market. None of that puts more metal in the ground. None of that builds new mines. None of that reduces the industrial demand from solar panels, artificial intelligence servers, and military applications. The correction was a reset, not a reversal. It was the market purging the excess, creating a healthier foundation for the next leg higher. The positioning data that the bears cite as bearish is actually bullish from a contrarian perspective. When net longs are at multi-year lows, when speculators have already sold, who is left to sell? The weak hands have been washed out. The leveraged players have been liquidated. What remains is a market populated by stronger hands with longer time horizons. As for Kevin Warsh, the market has already priced in his nomination. The hawkish shock has been absorbed, and despite his reputation, Warsh will ultimately have to respond to the data. If the economy continues to slow, if retail sales remain weak, if the labor market softens, the Fed will cut rates regardless of who sits in the chair. The Fed does not control the economy controls the Fed. Let me take you back to Shanghai because there is a thread connecting the regulatory change to everything we have discussed. The Shanghai Futures Exchange is not just adjusting hedging limits for administrative convenience. They are responding to the same forces that are reshaping the global financial system. China sees the volatility in Western markets. They see the speculative excess, the leverage, the disconnection between paper and physical, and they are taking steps to ensure that their market operates differently. By limiting the participation of overseas speculators in the delivery months, Shanghai is essentially saying that price discovery in China will be driven by physical supply and demand, not by hedge fund algorithms trading paper contracts. This is a profound shift. For decades, the COMEX in New York and the London Bullion Market Association have been the centers of precious metals pricing. The East accepted the prices set by the West, but that era is ending. The metal is moving east. The inventories in London and New York are declining. The Shanghai premium persists, acting as a constant signal that physical buyers in Asia are willing to pay more than the paper price suggests. And now Shanghai is reinforcing this shift by tightening the rules on its futures market. The geopolitical dimension cannot be ignored. We are not just witnessing a change in market mechanics. We are witnessing a change in global power structures. The BRICS nations are accumulating precious metals as part of a deliberate strategy to reduce their dependence on the dollar. They are creating alternative payment systems. They are trading in local currencies. They are building a parallel financial architecture that does not rely on Western institutions. Silver plays a unique role in this transformation. Unlike gold, which is primarily a monetary metal, silver is both a monetary metal and an industrial commodity. You cannot build the infrastructure of the 21st century without silver. You cannot manufacture solar panels for the energy transition. You cannot produce the electronics that power artificial intelligence. You cannot build the weapons systems that maintain military dominance. Silver is the blood in the veins of modern civilization, and the nations that control the supply of silver will have strategic leverage over those that do not. Let me paint you 3 scenarios for how this could unfold. I call these scenario alpha, scenario beta, and scenario gamma. Memorize them because the market is always playing out one of these stories. Scenario alpha is the gradual grind. In this scenario, precious metals continue their recovery in a measured, methodical fashion. The economic data comes in mixed, neither strong enough to derail rate cut expectations nor weak enough to trigger panic. The Fed signals patience, keeping the market guessing about the timing of the first cut. Silver slowly works its way higher, testing resistance levels, pulling back, testing again. The volatility decreases. The headlines become boring. Retail traders lose interest and move on to the next shiny object. But underneath the surface, the smart money continues to accumulate. The physical premiums remain elevated. The eastern vaults continue to fill. This is the scenario of quiet accumulation, and it rewards patience above all else. Scenario beta is the explosive breakout. In this scenario, a catalyst event shatters the equilibrium. Perhaps the next jobs report comes in dramatically weak, confirming that the economy is sliding into recession. Perhaps geopolitical tensions escalate, with a crisis in Taiwan or a military confrontation with Iran. Perhaps a major financial institution fails, revealing the fragility of the over-leveraged system. In scenario beta, the rate cut expectations surge. The dollar collapses. Capital floods into safe haven assets with desperate urgency. Silver does not gradually climb. It gaps higher, blowing through resistance levels in a matter of days. The short sellers are squeezed. The algorithms reverse their positions. The $100 target that seemed distant becomes a near-term reality. This is the low probability, high impact scenario, and those who are positioned in advance capture life-changing gains. Scenario gamma is the retest. In this scenario, the current rally falters before reaching the key resistance levels. Perhaps the economic data surprises to the upside, delaying rate cut expectations. Perhaps the dollar finds a bid, pressuring commodities. Perhaps regulatory action in the West, similar to what we saw in 2011 with margin hikes, forces another round of liquidation. In scenario gamma, silver pulls back, retesting the recent lows. The bears proclaim victory. The weak hands panic sell once again. But the fundamental picture has not changed. The supply deficit remains. The industrial demand continues. The Eastern accumulation persists. And for those with capital and conviction, the retest becomes another buying opportunity. This is the scenario that tests your thesis and your temperament. Let me speak directly to the different types of investors in this audience. If you are holding physical silver, I want you to take a deep breath. You are in the strongest position of anyone watching this video. You own the actual metal. You do not have counterparty risk. You do not have margin calls. You do not have an expiration date on your position. The price fluctuations on your screen are just noise. They represent the trading of paper promises between speculators who will never touch an ounce of actual metal. Your silver is real. It is in your possession or in allocated storage with your name on it. The weight has not changed. The purity has not changed. The industrial applications have not changed. Whether the screen says $80 or $60 or $100, you still hold the same amount of metal. The strategy for physical holders is the simplest strategy of all. Do nothing. Hold. Accumulate on significant dips if you have the capital. But do not let the volatility shake you out of an asset that has preserved wealth for 5,000 years. If you are a trader using leverage, you are playing a different game entirely. You are not investing. You are speculating. And speculation requires different rules. The volatility we have seen in early 2026 has destroyed accounts. Traders who were right about the direction but wrong about the timing have been liquidated before the move played out. This is the cruelty of leverage. It magnifies your gains when you are right, but it eliminates you when you are wrong. My advice to leverage traders is to reduce position size dramatically. The events on the horizon, the Trump visit to China, the potential escalations in Iran, the Fed policy decisions, these are binary outcomes that can move the market 10 or 15% in either direction. If you are leveraged 3-to-1, a 15% move against you is a 45% drawdown. That is account destruction territory. Trade smaller. Use wider stops. Accept that you will capture less of the move in exchange for surviving to trade another day. If you are sitting on the sidelines with cash, waiting for the perfect entry, I want to challenge your thinking. The perfect entry does not exist. You will never buy the exact bottom and sell the exact top. The goal is not perfection. The goal is participation. You need to be in the game to benefit from the move. The question is how to enter with a risk profile that matches your temperament. Watch the premiums at the physical dealers. If the premium over spot is elevated, it tells you that physical demand is strong despite the paper price weakness. This is a signal that the smart money is accumulating. Consider dollar cost averaging, making regular purchases over time rather than trying to time a single entry. This smooths out the volatility and reduces the emotional stress of watching your initial position fluctuate, and have a plan for each scenario. Know in advance what you will do if the price breaks higher. Know what you will do if it breaks lower. The time to make decisions is before the move happens, not during it. As we look forward, the convergence of forces is remarkable. Shanghai is tightening control over its silver market, limiting the ability of foreign speculators to manipulate prices near delivery. The U.S. economy is showing signs of weakness that point toward rate cuts in the months ahead. The dollar is under structural pressure from fiscal deficits, geopolitical tensions, and de-dollarization trends. Industrial demand for silver continues to grow as the world builds solar farms, data centers, and military hardware. And the physical metal continues its one-way journey from west to east, from the paper casinos of London and New York to the strategic reserves of Beijing and Mumbai. This is the setup. This is what the charts cannot show you. The price on your screen is a snapshot, a moment frozen in time. But underneath that snapshot, the tectonic plates are shifting. The old financial order, dominated by Western paper markets and the almighty dollar, is giving way to something new. We do not know exactly what that new order will look like, but we know that physical assets, things you can touch and hold, will play a larger role. We know that precious metals, which have served as money for millennia, will be part of that transition. And we know that those who understand this shift, those who position themselves correctly, will preserve their wealth while others watch theirs evaporate. The Shanghai announcement is not just a regulatory footnote, it is a signpost pointing toward the future. The rate cut rally is not just a trading opportunity, it is a symptom of a system that is running out of options. The volatility is not just noise, it is the sound of a market in transition, caught between the dying world and the one being born. I have prepared a detailed technical analysis of the key levels to watch in the coming weeks. It includes the support and resistance zones, the trigger points for each scenario, and the indicators I am monitoring for early warning signs. I cannot cover all of it in this video, but if you want the complete breakdown, the link is in the description below. Thank you for watching Mr. Ag. If this analysis opened your eyes to something you had not considered, hit the subscribe button and the notification bell. Share this video with someone who is trying to navigate these volatile markets. Drop a comment below with your thoughts and your location. Every comment helps this channel reach more people who need to hear this information. The game is changing. The rules are being rewritten. Shanghai just made a move that tells you exactly where this is heading. The question is whether you are paying attention. Stay skeptical, stay disciplined, and most importantly, stay safe. I will see you in the next one.